Focus for our clients ahead of the CPI number and, of course, that Bank of England decision. And wheat and corn at multi-month highs as weather concerns in the United States continue to underpin those prices. Let's take a look at the VIX first. Before we get to all that for you, now the volatility index has been traipsing lower, as you can see there, since the middle of March of this year. However, we are seeing some signs of a bottom here at 1594 to around 1626, that level. And suddenly it's sort of doing an upward motion from there. It has to be said that the VIX is still on track to end at its lowest level since January 17th, 2020. Now, as you know, US stock markets and bond markets, we closed this Monday for the Juneteenth federal holiday with 30 minutes to go until the European market open. Let's cross over to European indices to see what we can expect. This is the picture on the FTSE, looking like this at the moment as we count down to the open. If volumes hold, we could look at it opening down around 0.25%. Let's have a look at the DAX as well. Quite a similar picture there ahead of today's open. Flat, actually not flat, it's down around 0.4% ahead of the open. And also checking on the France 40, which is what it's called on our IG platform. But also known as the CAC 40, it is also charting or projecting down 0.33% ahead of the open. Overnight in Asia, most equities traded lower as investors waited on central bank meetings and more economic stimulus from China. Checking in on the close of Wall Street on Friday as well. That down arrows on Friday, if you remember, seeing quite a bit of a sell-off in the AI space, and markets across Asia also tracked that fall on Wall Street, which, according to Poon Panitshibul, a market strategist at Krung Thai Bank, said weighed on the South Korean won. As I mentioned earlier, equity markets in the US will remain closed today because of the Juneteenth federal holiday. However, you can still trade indices on the IG platform, even though you won't be able to trade US stocks. Two currencies and the British pound will be the center of attention this week for a number of reasons. One, its continued strength against other currencies. On Wednesday, consumer inflation in the UK is expected to slow to a new 14-month low. The market forecasts headline CPI at 8.5% in May year-on-year, down from 8.7% in April. Core inflation rate, though, is anticipated to remain at 6.8%, a record high reached last month. Then the Bank of England meets on Wednesday. A 25 basis point hike seems to be baked in. Bloomberg suggesting that the Bank of England will do a dovish hike to emphasize their drive to keep inflation down, but at the same time, I guess, keep consumers on side. The Bank of England has been walking this tightrope to try and keep consumption going, but at the same time warning consumers that they still have a keen eye on those very hot inflation numbers. It's also seen on this Bloomberg report that if the Bank of England does go a quarter point, it will then potentially pause. Last week, we saw the pound versus the dollar. This cross has been quite interesting for us because it has been very, very volatile of late. The pound versus the dollar posted its strongest weekly gain so far this year. This was in the previous week and now trades at a 14-month high. Also want to show you the pound versus the yen, which is drawing quite a similar trend there. trading. This crossed at its highest level since December 2015. And against the euro, let's have a look at the euro there. 10-month high against the euro. Now, before the Bank of England decision, other central banks are also expected to have some action this week. Starting on Tuesday in China, the PBOC is widely expected to lower loan prime rates by 10 basis points, which would take the one-year LPR down to 3.55% and the five-year LPR to 4.2%. Last week, the PBOC was expected to cut short and medium-term rates also by 10 basis points. Also on Tuesday, RBA minutes expected a couple of weeks ago. The Australian Central Bank unexpectedly raised interest rates by a quarter point, taking the cash rate to 4.1%. The statement from the RBA continued to suggest that further tightening could still be on the cards to tame inflation, and also this amid a very tight labour market. To corporate news, and AstraZeneca wants to spin off its business in China, according to information gathered by the Financial Times. The newspaper reported that the British pharmaceutical group is drafting a plan to list its Chinese operations as a separate unit, either in Hong Kong or in Shanghai. The drugmaker refused to comment on what it calls, quote, rumours or speculations around the future strategy or its M&A. The idea behind this is that while retaining control of a business that accounted for 13% of total sales last year, AstraZeneca would be protected from any tensions between China and other countries. Now, Make UK, the body that represents British manufacturers, has upgraded its outlook. This is for the industry. Make UK says strong demand for the aerospace sector, boosted by a resumption of travel and aircraft orders after COVID, and in the electronic sector will mean a brighter 2023. The organisation now expects factory output to fall by only 0.3% this year. 3 months ago, it saw a 3.3% contraction. It's sticking to its 0.8% growth forecast for 2024. Difficulties in sourcing materials are fading, but for medium-sized businesses, supply chain pressures still an issue. Let's take a look at oil prices as well, getting the oil chart up for you because we have a lot of volatility still in this space. Take a look at this chart. That's US crude on the platform. Oil sliding more than $1 on those uncertainties surrounding the growth in China. This is outweighing OPEC Plus's moves to cut output and bolster the price of oil. And it's the 7th straight drop so far in the number of oil and gas rigs operating in the United States. The number of oil and gas rigs in operation fell again last week, according to Baker Hughes. The total rig count fell by 8 to 687. The number of oil-producing rigs alone fell by 4 to 552. Dry conditions in the United States, the Midwest, is raising concerns among soft commodities traders. Wheat, corn, soybeans all set multi-month highs. Let's take a look at that for you, starting with soybeans here on the platform. As you can see there, quite a steady march up since the June, end of May date here, and it's been getting steeper ever since. Same for corn as well. The picture here, let's get corn up for you. There you go, similar march up for corn, and as you can see there, it ties in with the previous chart for soybeans. Around the end of May, we're seeing this quick tick up, if you can see from my chart here, up to the 600 level. And if we progress through and break through the 601 level, we could see the march back up towards 600 148, a level not seen since the middle of April. Last month, the US Department of Agriculture predicted record corn and soybean harvests in 2023. And this sent prices to levels not seen since November 2021. But at the end of last month, Chicago wheat hit a 2.5-year low. Now, all this is down to the weather. Temperatures are on the rise. Crops are already struggling due to the lack of moisture and water. And as you can see here, a similar traipse up on wheat futures. US markets will be closed on Monday, so no trade until tomorrow for commodity traders or those wanting to trade these assets on the IG platform, but we'll be keeping a close eye on the weather forecasts for you in the Corn Belt and affected areas in the US. And that's it from me for now, but do tune in at 10:30 where we have charting as per usual, and also for all the market moving events for Tuesday, do tune in to my look ahead a little later in the session. Until then, I'm Angeline Ong, and this is IGTV.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.